Commodity prices are on fire at the moment. Is it a blip? Is it a trend? Can we invest into it? In today's episode, I look at the facts and explore what's going on and what you and I should be doing about it. So why are commodity prices going through the roof at the moment? Well, you've got to understand with commodities, they actually operate in really long-term trends and cycles. They can last 50 years sometimes. And we've got data going back hundreds of years to validate this. But within those really long cycles, they tend to have kind of 5 to 10 year, what you could almost call super cycles, where they absolutely skyrocket because of some kind of mixture of supply and demand dynamics. You've got to understand that these are very volatile. It's a little bit like if you've invested in the crypto world, you'll know that Bitcoin can go up or down 10% in a day, whereas if you're in a stock market investing situation, that's kind of what you expect in a year. Well, I would say the volatility of commodities is not quite as extreme as cryptos, but it's certainly more than you'd see in the stock market. But again, as an investor, you have to be prepared to have a stomach to ride that out, because overall, they'll tend to be in a longish term uptrend or a longish term downtrend. But again, a bit like stocks and shares, they tend to go up slowly and down quickly. But you can, as a smart investor, get on board at the right time and ride that wave up for sometimes years at a time, and then just have to make sure you get out at the right time before the downward trend starts happening. All the signs to me at the moment are suggesting that we're in the relatively early stages of one of these 5 to 10 year uptrends. But what you've got really is quite a complicated mix of demand variables. And you've also got situations where what you could call price inelasticity, meaning that rising prices can occur even if demand is falling. We've seen this in the past with commodities like lead, which obviously became very unpopular. We have unleaded petrol that was taken out of paint and all the rest of it. But the use of lead did not suddenly disappear. What happened was people stopped investing in new supplies. So supply became more scarce. There was still demand. So the price went up even though overall demand was falling, but supply had fallen even further. Therefore, economics 101, the prices started going up. And what happens with commodities is you'll get these cyclical swings from there being a shortage to eventually there being a glut. But in between, because of the nature of what it takes to produce these things, it can take 5 or 10 years to address the shortage with new mines, new oil wells, new refineries. These things take years to develop. And if you think about things like nuclear power stations and all the NIMBYism and the parliamentary inquiries or third airports at Heathrow and Gatwick, these things can drag on for a lifetime. So that's why sometimes these price booms and these areas of undersupply can last a lot longer than you think, and can even see rising prices when you thought a commodity's usefulness was perhaps over. And wait till you see one or two of the things I'm going to show you about the last 12 months. So you've got a lot of capital needed for these things and long lead times to produce them. But also we've now got a kind of a rising political tide against some of these commodities, particularly from the ESG community, the climate change agenda. So there's an awful lot of pushback against investment in these things. And there's hardly a day goes by without me reading some press release from an investment or pension fund saying, we are going green, we're going ESG, we're not going to buy BP or Shell or Exxon, we're going to avoid all these horrible, dirty, polluting companies. And that actually is going to create some enormous opportunities, because oil ain't dead yet, coal ain't dead yet. Whatever they might wish the world to be, we aren't there yet. And so, you and I live in the real world, and we're looking for investment opportunities, and I think you might find there's some contrarian ones coming along. Now, this enormous table is the periodic table of commodity returns for 2021. I'll let you analyze that in depth by freeze framing the video, but let me just pull out a table from Visual Capitalist of the highest performing commodities in 2021. And look, what's at the top of the heap there? Old King Coal, 160% increase in 12 months. Who'd ever have thought, eh? Something that everyone says was dead, dirty, horrible, not to be gone close to. It's up 160%. And what's right behind it in second place? Crude oil. And then you got gas and aluminium and zinc and all the rest of it. So you can see that a lot of these commodities have soared in price. In fact, the only things that really have disappointed have been precious metals. And we've had a bit of action finally from gold in 2022, but 2021 was another disappointing year for the yellow metal. That said, I'm still holding it, and I'm still buying it, and I'm still accumulating it for other reasons than just making a quick buck. But certainly, I think the key point I want you to take from this chart is that things that you might think are unfashionable and not to be a core part of investment portfolios in the what you might call the traditional investment world, well, actually, they're still going up hugely in value because the world still needs them, and in many cases, supplies have been shrinking, but demand has not been shrinking, and therefore prices go up. And let's face it, if you've got a car, is there a point at which you would simply leave it in the garage and stop putting petrol in the tank? Or would you find a way of paying £2 a litre, £3 a litre, £5 a litre? What else would you sacrifice to keep your mobility? These are the kinds of questions we may well face in 2022 and beyond as some of the prices of these commodities continue to skyrocket. So there's kind of part of you as a user of these commodities will be upset at the rising prices, but as a potential investor in them, clearly you should be targeting these as part of your portfolio. So the base metals have actually produced a much higher return than the precious metals. If you look at the table there, you can see that some of the star performers have been the base metals, and some of the underperformers last year have been the precious metals. It'll be interesting to see if that trend continues in 2022. I suspect we'll finally see gold and silver performing as we might expect them to, better this year, partly because more and more people and more governments and central banks will be looking for a safe haven in which to preserve their wealth. Because if you've got official inflation figures nudging up towards 10%, probably means real inflation is double that. So money that you're keeping in the bank is going to lose its value so quickly now that you're really going to want to think of somewhere else you can put that wealth. So I think we might well see gold and to some extent silver really coming into their own this year, but they certainly failed to shine in 2021. Now, commodities is an area that's close to the heart of one of the world's top investors, Jim Rogers. Here's a book he wrote back in, I think 2004 now, called Hot Commodities. Really great book, and really, I think, very relevant to today. I've certainly been rereading my copy in the last few weeks, and I had the privilege of meeting Jim when we shared the stage at the World Wealth Creation Conference in Singapore a few years ago. And I had a Sky TV crew with me. We were making a documentary about the event, and Jim gave me an interview there. And he's been bearish about the stock market for some time, but he's now really bullish about commodities again. And in fact, after he wrote the book in 2004, commodities absolutely skyrocketed through to about 2011. And then we went into a downturn from which we're only just now, 10, 11 years later. I think we bottomed out around 2020, early 21, and now I think we're back on that upward trend. So, Jim Rogers, well worth reading his thoughts on commodities, and I certainly have a huge respect for him, and it was great to share that time with him over there in Singapore, where of course he still lives. He set up the Rogers International Commodities Index, and I wanted to show you it not just in the last few months, but to give you a view back over 5 years. And you can see it's been fairly steady until, as I say, around 2011 it came down, probably eventually a knock-on effect of the financial crisis in 08, I think. And then it's been actually on a steady upward rise that suddenly accelerated as we've come into 2022. So it still looks relatively early doors in terms of getting on board. As long as you accept there will be volatility, but I think we are certainly in the early stages of this upswing. And as you can see, the Rogers Index has been performing really well in the last few months. And this is the commodity index within the S&P. As you can see, that reached a huge peak, again, just around the time of the financial crisis, then had a significant slump. Then it was kind of plateaued for a while, back into another fairly rapid downward trend. But again, if you look, this is what I mean about being in the early stages. You can see we're just coming back up there with a long, long way to go to retouch those all-time highs from back in the 2000s. So that's where we are at today, and it feels to me like a good time to get some exposure to commodities. And one of the nice things about them is that there's a load of ETFs, exchange traded funds, a load of indexes where you can track commodities if you want to just look at a general market or even a specific commodity. There are ETFs on wheat, there are ETFs on corn. You've got your choice of all these different things, or you can take more generic ones, which will obviously even out some of the volatility, but may not give you the maximum return that a particular commodity might do. One of the reasons we're in the position we're in is that for the whole of the 2010s decade, all the money piled into big tech. It was Google, Alphabet, Facebook, all these guys got all the major investment, and they're all what you might call jam tomorrow companies. These are companies that are going to have huge profits in the future, and you invest today without any kind of thought of dividends or income from them, but they're real high growth stocks. And they have delivered on that, to be fair, until now. And what we're seeing now is as the world goes into risk-off mode and looks for more value from its investments, these companies are out of favor. But the trouble is, all the money that was going into those companies was not going into commodities. So the underinvestment in infrastructure to produce commodities is now being felt. And it's too late to fix it overnight. So we're now in the process of what could be a 5 to 10 year tooling up, reinvesting more capital into wells, refineries, and agriculture and so on to boost those things up again. And that's the wave that I think we as investors can now ride based on the fact that it's been ignored for a decade. It can't be ignored any longer because real supply shortages are going to hit us, and that's been accelerated by the events in Ukraine, but it was already an underlying trend waiting to happen. See, the thing is with technology, a lot of it is software code, and code can be written in weeks or months, and it can be implemented quickly, and it's infinitely scalable. One of the reasons why these platforms can become so profitable is that once you've built the thing, whether that's Facebook or Google or Twitter, YouTube, once it's there, the overheads are pretty constant, but the traffic keeps on increasing. The revenue from advertising and so on keeps on increasing, so they become enormously profitable. But mines, oil wells, refineries, they don't take weeks to code. They take years to get through planning, to get through all the NIMBYs and the public inquiries. Then they need the capital to build them. Then they need to be commissioned and tested. It's a 5, 7, 10-year process. And of course, they have a limited capacity. Whatever that capacity is, it's not infinitely scalable. And the same goes for Farmer Giles's fields. They are what they are. He can produce what he can produce. There are Obviously there's technology, there's fertilizers if you can get them, that increase the productivity of that land, but there's still a finite limit. It's not infinitely scalable. So these are fundamental differences between what investments have been flavor of the month in the previous decade versus what I think we're going to see a lot more investment in this decade. And those fundamental differences will drive the values and the share prices of the companies involved, the dividends and returns to investors. So this needs a whole new kind of analysis to work out what needs to go in your portfolio to prosper in the 2020s. Now, one of the things that you need, obviously, to keep this kind of price hike in commodities going is more and more demand. Now, in the days when Jim Rogers wrote his Hot Commodities book, China was the big story. They've taken 600 million people out of poverty in the last 20 years, and that's generated enormous demand as the kind of middle class, if you like, has grown. Well, China's not going to stop growing, but its population is probably going to max out in the next decade or two. The next big one that I see coming along is India. And India has a big population, it has a young population, it has a highly educated population. And up until now, one of my neighbors here in Portugal has an Indian background, and she was saying that a lot of educated Indians have left the country to go elsewhere. She actually ended up in Sweden working as a medical doctor. A lot of them go to America and work in Silicon Valley. But that's starting to change. There are starting to be opportunities to stay in India and prosper. So the Indian middle class is going to grow enormously with a huge increasing demand on the world's resources as they do so. So again, we'll see a middle class probably bigger than the entire population of America developing this decade in India. And the rest of the world's demand is not going to go down. This is one of the weird things about energy and resources. We keep on using more and more, even with stable populations, because I suppose we want more and more. We get wealthier, we buy more stuff, we get new stuff, we refurbish our homes regularly. It all takes resources and energy. And I was fascinated to learn that we actually use more wood today than we did 200 years ago when it was the primary building material. But there you go. And that's true across all these types of resources and commodities. And world population is going to peak. It hasn't peaked yet. And when it does peak, it'll start reducing very slowly. And if GDP continues to rise and wealth per capita continues to rise, again, the use of resources will continue to increase. So although you might have a view that says overall we may have kind of reached maximum population, it's certainly not true in terms of maximum wealth or maximum spending power or maximum use of commodities. So my question of the week for you is, what commodity investments have you made lately, or what do you intend making soon? This is too big a trend to miss out on. So tell me in the comments section below the video, have you already got commodity investments, or based on what you're learning, are you going to make some investments very soon? Tell me what you're up to. So what does all this mean for us as hopefully smart investors? Well, firstly, you should have some exposure to both hard and soft commodities. And that is easily available through exchange-traded funds on all the major platforms. You just have to do some homework and decide where you think the biggest opportunities are and where you're going to start putting some money. You can go a bit more high risk, high reward if you want to by looking at specific companies, whether that's energy companies like BP and Shell, whether it's mining companies. Obviously, they've all got their own risk-reward model. You've got to look at perhaps the benefits of dividends from some of the major oil producers. You've got to look at the potential for massive rewards. If you're, say, a gold miner who hits a new seam, that can be enormously profitable, but equally, lots of mining companies don't achieve those results. So higher risk, higher return, but obviously you could look at that as part of your portfolio. But one of the things I'd suggest is that because of the volatility in commodities, it's probably best not to put a whole lump of money into one fund on a single day, because you might find it's down 10% tomorrow, a bit like the crypto world. So I would apply the same approach here as we do in the crypto world, which is dollar cost averaging. Just decide what you can afford to invest each month, decide which vehicle, whether it's an ETF or shares, that you're going to invest in, and put that amount in each month and just ride out the volatility, which is hopefully in an upward trend over the next few years. Regardless of the ups and downs, you'll gain from that. You'll get more some months and less other months depending on those price movements, but you won't have made one big bet at one point in time, which is kind of the highest risk approach to this sort of investing. And also, as you try to analyze particular areas of the commodities market, watch out for the kind of frothy peaks and the times when it all kind of comes back down to earth a little bit. So, for example, I'm looking to invest in coal, but I'm not going to do it right now when it's just gone up 160%. I'm going to wait until there's a bit of a pullback there. If there's a pullback, then I'll go into coal. So just make sure you try to avoid investing at the absolute peaks, and just watch those peaks and troughs as they go over time, and try and time your investments as well as you can within that. So hopefully now you're getting familiar with the wealth pyramid and its 4 layers. I've explained them to you in the past, but the main thing is, what does your wealth pyramid look like? Have you even started building one? And I have a 4-page explanation of how to do that, because there's nothing better in investing than knowing where you are today. There's no judgment here. It doesn't matter whether you're at the start, whether you wish you'd done this or that 20 years ago. The point is, know where you are today and then start building on that layer by layer, month by month. So if you want help with that, I do actually do 90-minute one-to-ones, which are kind of wealth pyramid reviews of where you are today and perhaps where you might like to go in the future. I can't give specific investment advice, but I can help you to structure your portfolio, ask yourself the right questions, and make sure you're taking advantage of everything that's out there at the moment. So if you're interested in one of those slots, I only release a very small number each month. You can find out more at renegadeinvestornation.com or email admin@renegadeinvestoracademy.com. Thank you very much for watching. I'll see you next time.